sales right out of the gate, and that's where we priced right out of the gate. So lest you think high growth, high valuation stocks are a new phenomenon, I assure you they are not. Now, later that same year, our story started to catch on with Wall Street, and our stock started to go up for basically no reason at all that I can point to. But within a matter of about 6 months, it was a reasonably good time for growth stocks. The market was shining on that, and our stock went from $15 to $27.85 in about 6 months. And I vividly remember being at a conference when this was happening. Everybody had smiles on their faces, right? All of our stock options, all of our restricted stock was well into the green. Life was good. We just raised a whole bunch of capital. We were hiring people. We were growing. Everything was fantastic. By the end of the year, our revenue hit $13 million. That was up 300% over the prior year. Now, the rest of the income statement was pretty darn ugly. It cost us $26 million to make the product, so our gross margin was negative 95%. That's not good. You add in everything else, all the other spending we were doing, and our net loss for the year was $54 million. And we had about $94 million in cash in the bank. So we had about 18 months, two years roughly, of runway, and the price to sales ratio was at this point 49. Not any of those numbers scream, hey, bargain, or let's get in on this thing, right? We were still an unproven company at the time, but we had a lot of promise. Well, what came next? The answer is 2008. And in 2008, the market conditions started to flip, and they flipped in a hurry. So our $27, $28 stock started to fall because the markets really were not interested in high growth, money losing story stocks, which we were at the time. So our stock, for essentially no reason at all other than market conditions, went from 27 to 25 to 20 to 15 to 10 to 5, and we ended up bottoming in March of 2009 at $2.57 per share. That is a 90% peak to trough drop. 90%. All of our options were underwater. All of our restricted stock was underwater. And arguably, in fact, you could verify this with the financials, the company was a better company in March of 2009 than we were in July or August of 2007, even though our stock had fallen 90% during this period. Now, thankfully, after bottoming, we continued to grow our revenue, and our margins slowly improved. We added on more people, and we continued to take market share. Our stock gradually recovered, and within a few years from that bottom in roughly 2011, our stock was back to $14 per share. So that was a 5-year trip from 15 to 27 to 3 back to 15, and over that 5 years period, people that bought at the IPO earned 0 and got a ton of heartbreak. But after that 5-year period, our revenue had gone from $10 million to $66 million, and our gross margin went from hugely negative to hugely positive. And we clearly had a lot of business momentum behind us. Now, if you fast forward over the coming years, we continued to grow and grow and grow and grow, and then growth really started to take off in the 2017-2018 time period. And I'm looking at the price of Insulet's stock today, and I see a price, let me just see, of, The last quoted price of Insulet today was $253 per share. And that is, like many growth stocks, down about 30% from its peak price just a few months ago. So if you manage to buy our stock at the absolute worst possible time in 2007 and hold through all of that nonsense, you're currently sitting on a 9-bagger. If you bought at any time from when it went from 27 down to 3 or under 3, you're looking at many, many, many more bags than that. But I assure you, living through that was an awful experience. Just awful. It was so disheartening to see that all of the work we were doing and all the progress we were making was essentially being ignored, just completely ignored by the market, simply because the sentiment in the market went from high growth, high valuation stocks are awesome to high growth, high valuation stocks are garbage. And that momentum shift caused us to have to sit through a 90% decline and essentially a 5-year round trip to nowhere. But when I look back at the history of working at that company, every single quarterly report that we put out was better than the previous one. Every single one, revenue was up, margins were enhancing, we were rolling out new features and new products. It was getting better and better from the business perspective. So this is why I try and harp all the time on Twitter about saying focus on the business, not on the stock. Boy, is that hard to do. Boy, it's so easy to say that out loud, but and it's even easy to like mentally accept that. Yeah, I can handle volatility. I can invest in the stock market. Give me growth stocks. But when you go through times like we've been through over the last year, it feels like you can do nothing right. It feels like every stock that you buy and every decision that you make is pretty much wrong. And if you were a recent buyer of Facebook's stock, you probably feel pretty awful right now with shares down 22% for I don't even know what reason. I haven't even looked at the earnings report as of yet. But that's the volatility that you sign up for if you're going to invest in individual stocks. So when I think about my own personal emotions and what I've gone through over the last year, I've been invested now through the 2008 crisis and the 2020 crisis. But all along that way, I had plenty of individual holdings of mine absolutely get creamed, down 70% plus. And every time it's happened, it doesn't feel good, but you just slowly kind of get used to that happening if you're going to invest in high growth stocks. And despite that immense pain that you have to go through on occasion, I still really believe that the effort of looking for and finding a dynamic, high growth, strong companies with long-term growth cycles ahead of them is still worth the effort, because if you can just find a handful of the next great growth stocks and get them in your portfolio, all the pain and anguish that you have to go through along the way, I'm very confident will be rewarded in the long term. But man, oh man, will it test your resolve while you're living through the day-to-day gyrations.
Yeah, absolutely. I think we're living in the thick of it right now and definitely feeling maybe what you were feeling at the time. One of the topics that I wanted to dive into with you, I think you often share, you know, anecdotes from some of the investments that you've made over the last couple of decades. I would love to hear from you, maybe if you had to pick a couple, what the biggest mistakes were that you made, and also conversely, what the biggest wins were.
Sure. So I've made just about every mistake that you can possibly make along the way. I've made mistakes with leverage. I've made mistakes with buying things and making them huge positions, being extremely confident in them, only to see those stocks go down hugely. I've bought penny stocks that I couldn't tell you a thing about the business or the operating conditions. I've bought high dividend yielding stocks that turned out that those dividend stocks didn't get paid, and all of those are mistakes that I've made and I've learned from. But I would say the biggest mistakes, all those mistakes suck and they hurt like crazy. But the biggest mistakes that I've made all really contain one word, and that word is sell. Right? I had at one time in my portfolio shares of Microsoft, and I was a buyer of Microsoft at $22 per share. $22 per share. Microsoft currently trading at 313. But I no longer have those shares because I sold them for about $24 per share. And that single decision has proven to be incredibly costly. The missed out gains that I had from selling Microsoft 15 bags ago dwarfs any potential losses that I had from buying a stock that was terrible, that then went on to fall 70% or so. And that's not even my worst decision on a percentage basis. As I mentioned at the start of the show, I worked in the diabetes industry, and I had firsthand knowledge of another up and coming company in the space called Dexcom. The ticker symbol there is DXCM. They had very similar business model, leadership team, margin profile, opportunity, et cetera, to us, except for they were even growing faster than we were working at Insulet. And I was friends with many of the people that worked there. I saw them on a daily basis. We collaborated with each other, and I knew firsthand that they were growing even faster than we were. And I bought shares, and like us, their stock got eviscerated in the 2008 crisis, falling from I don't even know what to under $2 per share. So like us, they went through a 90%-ish plus loss. And I actually bought the stock when it started to recover for about $6 per share. And that stock is currently trading at $435. So from where I bought, it's an 80 plus bagger. But yet again, I sold that stock for about $7 per share. So I sold the stock that then went on to go up, I don't know, 60x in value. And the missed upside from having that extreme winner in my portfolio and then selling it early, again, kind of dwarfs all of the losses that I've taken from buying bad stocks that then went down. So I've made tons and tons of mistakes, but the most costly ones are selling mega winners way too early.
Yeah, and that was something which I saw reflected in your presentation at FinSwick conference when you were really speaking about finding those companies and then just holding them through the bumps. Before we go into the next story, being a little topical here, what is this current market environment over the past year? Does it feel like a 2008 or a 2001? Does it feel different? Are there specific fundamentals or technicals within the market that stand out to you?
Oh, it definitely feels differently than it did in 2008. That's for sure. In 2008, everything was going down. Everything was under pressure. Right, the world economy was cratering, and it felt much more. I would say that feeling was much closer to February and March of 2020, when everything was tanking all at the same time, and the government was freaking out, and the world changed in a matter of weeks. More recently, it's been very strange because, as everyone knows, the indexes have largely continued to shoot higher, but certain sectors of the market, mainly those that did really, really well in 2020, are the sectors that have been under so much selling pressure as recently as people rotate out of those high growth, super highly valued stocks into other areas of the market that have been left behind. But don't think that that is like anything brand new. If you look back through history, there have been several instances when this has happened, and I forget the exact years, but I think it was 2013 to 2014, something along those lines. Something similar was happening, where some of the best, highest growth stocks in the market declined pretty rapidly, even though the overall indices were charging higher. And again, that was very similar to what's happening today. It was merely rotation. Growth investors, by and large, were fleeing highly valued growth stocks, and they were taking their capital and putting it into other areas of the market. I've heard similar stories happen in 2006, although I wasn't investing the way I do now back then. I heard the same thing happened back in 1998, believe it or not, in the height of the dot-com kind of craze, or when it was still going crazy. There were some sectors of the market that were tanking. So I would say it's closer to feeling more like that than anything else. And broadly speaking, when your investing style is out of favor, it sucks. It sucks, right? Because it feels like everybody else is making money, everybody else is outperforming you, and you feel like you're doing everything you do is wrong, and you just feel like you're like the worst investor in the world. Historically, if you look back, when things are out of favor, that means that they're likely to be primed for outperformance moving forward. But again, that's just a part of investing. If you're on this call, the odds are pretty good that you are investing in individual stocks, or at least investing in the stock market in general. You just have to know going in, there's going to be periods like this when everything you do feels like you're doing everything wrong. But you really got to stay focused on the long term, as hard as that can be, because that's really the only term that matters.
Perfect. So one of the stories which you laid out on here, which I thought was super interesting, and I think maybe more people would be intrigued by hearing this, was actually about uh, the 401k and how it was created by accident. Can you elaborate on that?
Sure. Yeah, the 401k has been around for just about 40 years now. And back in the early 1980s, there was actually a change to the tax code. And there was a lawyer that was reading through some of the tax code changes. And what he noticed was the new language was vague enough to allow for essentially the creation of what we now know as 401ks, and that was the tax code section that it was found in. It was section 401 part K. So what this lawyer did, I'm pretty sure his name was Ted Bana, is he went to his own company's HR department and pointed out this change and said, look, with this, we can actually defer compensation. We can actually invest it in the stock market, and this can be a benefit that we give to our to employees, and we can take advantage of this. And he successfully convinced his employer to start offering this that benefit. Now, slowly over time, more companies kind of caught on, and word kind of got out that there was this quote unquote wrinkle in the tax code, and that is how the 401k ended up being created. They didn't go out and specifically say, hey, let's set up this account program and have it so that people could invest in the market and do it in a tax deferred way. And yet that is now the number one way that people save for retirement. So if you are invested in a 401k and if it's done pretty well, we owe a hat tip to that lawyer who discovered that legal, essentially, loophole.
Perfect. I'm pretty excited to see that story, and I wonder if other areas of finance and maybe it was options or whatever else what else could maybe have come from something that was an accident, right? And just like products that have been created, as more products seem to be created, we have mutual funds and ETFs and so many other things, with crypto and everything. Are there more financial vehicles and products that you see coming to market over the next decade, especially ones that are targeting retail?
Oh, I'm sure that there are. If there's anything that we've seen over the last 20 years, it's innovation in the financial sector of making it easier and providing more products for people to invest in. As to what could potentially be on the horizon, boy, I don't. I have no clue myself. Some of those financial things that come to the markets are fantastic. ETFs have been great. Low-cost index funds have been great. Commission fee orders, I think, by and large, have been the positives outweigh the negatives. So we as investors today are incredibly spoiled. It's so easy for us to put money into the market like ever before, and it's so easy for us to get information about businesses. Like I don't even know how I would do what I do now if it wasn't for like the internet. Like, can you imagine having to like write to a company for them to send you their financial information? Or how would you even learn how to dissect information? I mean, you can do all that kind of stuff today thanks to FinTwit, thanks to YouTube, thanks to blogs, etc. So, what innovations are around the corner? I don't know, but I bet there's going to be plenty of it.
Yeah, I'm looking forward to it as well. So let's zoom out a little bit. Brian, I think you inspire a lot of people to at least get started, right? You show them the long-term potential of the market. So maybe breaking it down to the basics for the audience, why, your book is called Why the Stock Market Goes Up Over Time, right? Why does the stock market go up over time? If you could kind of break it down for us. And should people be picking individual stocks, or based on stock market go up over time, should they be leaning more towards SPY, Q, stuff like that?
So I'll start with the second question first. Should people be picking individual stocks? So I am a huge proponent of the stock market. I live and breathe the stock market. It just like endlessly fascinates me that companies can come public, that they can raise money, that all investors are essentially working with the same information, but yet if you approach the markets with a different mindset or you analyze things slightly differently, that you can do well over time. And I love turning over, picking through companies and trying to find out which ones are best and thinking through business models. Like all that kind of stuff just like endlessly fascinates me. But I know that if anybody here talks to their friends in real life about this stuff, I'm guessing you have the same experience that I do, which is like most people's eyes glaze over when you try and talk to them about the stock market or you try to explain concepts to them. Like for most people, the vast majority of people, it's like a big yawn to talk about stocks and investing. They're just not interested in. So I would say the answer to should I buy individual stocks or individual funds is 100% dependent on you as a person. Like, does the idea of reading through a 10K bore you to tears? Like, would you fall asleep? Would that feel like gut wrenching homework assignment? Or would the idea of researching companies, creating a watch list, communicating with other investors, digging through conference calls, does that actually mentally excite you? And does that concept actually give you joy? If you're in that latter group that actually enjoys researching companies, finding them, analyzing them, then I absolutely think individual stock investing could be for you. In my experience, I would say that that's roughly 1 to 2% of the general population, but yet a whole bunch of that 1 to 2% of the general population is on FinTwit. So if you're the type of person that is interested in this stuff, I think that stock picking is a great choice. But for the vast majority of people, I just say buy index funds, dollar cost average into them, and forget about it, and you'll likely do fine. So that's answered that question. As for why does the stock market go up, this is the question that perplexed me personally for years. Right? Nobody had ever explained to me what the stock market was, and And importantly, I'd read many great books about the stock market. All of the classics, the Buffett books, the Peter Lynch books, the John Bogle books, the Jeremy Siegel books, etc. And all of them say similar things, right? Buy great businesses or buy index funds, dollar cost averaging the market. The market's long-term returns are positive, and you will do fine. You'll earn that magical 10% per year somehow. I never understood why the market earned 10% per year, but I always heard that it did earn 10% per year. But no, I never read a book or came across anything that explained kind of the why behind the stock market goes up 10% per year. So the advice that's given, dollar cost average into index funds, long periods of time, and you'll do great. I 100% agree with that. But I always thought, man, I really wish somebody could explain the why behind the market going up to me, so I could understand that in a simple way. But nobody ever wrote a book about it. So a few years ago, about 18 months ago, I was conversing with Morgan Housel, who wrote a book, and he and my friend Brian Stoffel kind of tipped me over the edge and said, "Well, maybe you're the one that's supposed to write it." And I was like, "Huh, I don't know how to write. I don't know how to write a book. That sounds like a lot of work." But the pandemic provided a perfect opportunity to start. But to answer the question, if you're familiar with what a price to earnings ratio is, if that concept resonates with you and you can understand what that means, you can perfectly understand why the stock market goes up over time. The answer is fairly simple. The earnings of the S&P 500 go up over time. And if the earnings of the S&P 500 or the components of the Dow or the components of the NASDAQ rise over time, eventually the stock prices of the individual components of those indexes will also rise over time. The tricky thing is finding out the earnings of the S&P 500 isn't easy. It's not easy to even find a chart that shows the long-term earnings power of the companies in the S&P 500, of the companies in the Dow Jones, of the companies in the NASDAQ. And then if you look at the components themselves, well, what is the thing that causes those earnings to go up over time? Everyone here knows is probably familiar with the growth driver behind it. Things like productivity, things like population growth, things like international expansion, like stock buybacks, like dividends, like margin improvements, like innovation. Those are the primary drivers that push those earnings up over time. And I've found that once somebody explains that to you, it's not a hard concept to really understand. The big question moving forward is, will all those growth drivers continue to be in place indefinitely? I still think the answer to that question is a firm yes. So that's why I am a kind of permabull on the U.S. Stock market, and I think it's going to continue to go higher, hopefully for the rest of my life.
Absolutely, that would definitely be a great hope. One thing, Brian, real quick, stock markets. I'm not sure if you can hear this. There's a little something, just the sound quality. A couple DMs I'm getting. There's like a little sound that's rattling. Maybe it's a watch or something being shuffled on your end.
Okay.
I don't know. I'll just let you know if it comes up. Just got a couple DMs, some people who I think where the sound was coming through to them. So I wanted to ask your thoughts, and I think that a lot of my audience like to diversify into different assets. And one of the more popular ones now is becoming crypto. In many ways, there is crypto staking, there's farming, there's just buying and holding, and a lot of other things that go on with that. Have you looked into the world of crypto, or do you have any exposure to it?
Yes and yes to both those questions, and I think the answer was that was coming from the cord that I have. So I will try and sit still. I generally try and walk as I talk, but hopefully, if that's screwing up people's sound, I apologize for
Yeah,
that.
that was the sound.
So when it comes to crypto, when I first heard about it, I was like I immediately was dismissive of it, and I very much hung on Warren Buffett and Charlie Munger, who are both completely against it. And as someone that understands stocks, understands the stock market, I was like, well, there's no cash flow here. These are unproductive assets, right? It's like gold. They're not going to throw off any cash flow. Therefore, I don't understand what the growth driver is over the long term that will make these things appreciate. So my thought process for many years was, while the price may go up and the price may go down, I have no way of knowing what they're going to do or analyzing these. So therefore, I'm just going to ignore the sector largely. I will say that my mindset has shifted greatly over the last 18 months or so, as I've learned more about it. And roughly a year ago, I opened a Coinbase account myself and started to put a very small amount of money in there just to experiment with buying Bitcoin, buying Ethereum. And I am still in the research and getting to know phase of those crypto assets and kind of learning about some other ones too. I will tell you, the thing that flipped my mind was hearing, first off, Naval and Balaji, I'm pretty sure, Srinivas Balaji. His podcast, both those podcasts on the Tim Ferriss show, really, I think, expanded my mindset about crypto and the way that I think about them. And the bigger question, especially with Bitcoin, that I can't get out of my mind is just ask the broad question: Should there be a global currency of the internet? Like, just ask that question. Should there be a global currency of the internet? I think the answer is yes. As of right now, the leading contender to be that global currency is Bitcoin. It is, in very many ways, the top dog and first mover in an important emerging industry. And I think that's likely, I think it's reached the critical mass where it's going to get to, that the number of people that are permables on Bitcoin will provide some sort of, not stability to the price, but let's just say a floor for the price. And the number of use cases that are going to be happening with blockchain technology, and the number of use cases going to be built on top of networks like Ethereum and all that kind of stuff are continuing to expand. So it is an area that I am still getting to know, but I will tell you that my mindset on crypto has flipped completely, and I do own a little bit, and I do have plans to buy more.
Perfect. And I think those were some pretty important questions which you laid out there. One more time, for anybody that's in the audience, if you're enjoying, Brian's thoughts, and I'm sure many of you have seen his tweets show up on your timeline often, you can go ahead and pre-order his book right now. It is his pinned tweet in his profile. Really cool looking cover. Why does the stock market go up? You can get it on Kindle for $9, paperback for $18, and hardcover for $28. Really, really interesting stuff. And there's a whole bunch more information than we're able to cover here. However, I also want to get in some involvement from the audience. So I did put out a tweet. And if anybody has, a specific question that they would like me to ask Brian, I'll probably grab a few from there. I pinned that tweet up to the top of this space. So y'all can check that out and let me know if there's anything that is suited. Okay, another story that I would love to hear from you, Brian. So you talked a little bit about the 2008 one, but you also had an experience during the .com crash. Is that correct?
Yes, that was when. Yes, so back in the early 2000s, that was when I was in college, and right before that was in high school. And I've read this before, that what the stock market does in your teens and early 20s actually can have a permanent impression on your views of the market, essentially for the rest of your life. And if you looked at asset allocation by birth year, the people that were investing that came of age during the 1970s, stock prices went nowhere. There was a huge bear market in 73, 74. There was a huge bear market in 80 to 82. And the thing that did really well during the 70s was actually commodities. So oil and gold and natural gas. And if you came of age during the 1970s in particular, you are highly likely to hold less stocks in your portfolio than somebody that came of age during the 1950s. And during the 1950s was like the go-go age when stocks were all the rage and they went up hugely over a period of years. And for me personally, so I came of age during, when I first became aware that the stock market was a thing. That was the late 90s, and that is when the stock market was in the news on a semi-regular basis. And I remember being out at a fancy country club that I worked at, and some of the golfers there were talking about the stock market and how the Dow Jones was up a couple hundred points, and they all had smiles on their faces. And I had no idea what any of them were talking about, but I was like, great. So this thing, the stock market is doing good. This thing, the Dow Jones is doing good. And these guys are obviously smiling. And I was like, maybe they made a couple $100. I don't know. And they probably made hundreds of thousands of dollars. Well, what happened in 2000 and 2001? That was the tech blow up combined with the dot-com crash. Combined with the September 11 attacks. And I also remember being in college, still had no clue what the stock market was or anything like that. And I remember watching CNN just like everybody else on September 11th and watching the attack on America, and also seeing stock prices just absolutely plunge. And at the same time, there was a lot going on politically with Gore versus Bush and who won the election and all of that nonsense. And I remember at the time I still had no clue what the heck the stock market was or what was going on. And I had a friend that was we were talking about politics or something like that, and I was like, well, obviously Bush is terrible because the stock market's gone down during his tenure, as if like he flipped a switch and that was the cause of it. And this friend said to me, like, no, that's like just markets being markets. That has nothing to do with who the president was. But at the time, I just assumed it was whoever was in charge of the country was responsible for what's happening. But it's just amazing how those were kind of the small little exposure that I had to the stock market. And I think a lot of people have something similar where the exposure they have to the stock market, if it's not a regular conversation in the house, is only during periods of market extremes. So markets are at all-time highs. That's when it makes the news, or markets are plunging. That's when it makes the news. And it's just so interesting how those moments can so heavily shape how we view the market moving forward. And my heart goes out to so many people based on when they started investing. If you started investing for the first time in March of 2020 or in April of 2020, like so many people did, the first exposure that you had to the market was growth stocks doing nothing but going straight up. And that you just thought you buy anything of any stock, and you just immediately are rewarded with this huge return. And conversely, if you guys started any time of the last year and you've bought growth stocks, the only thing that you've known is volatility and downside returns. And it seems like the stock market is rigged. So I consider myself lucky that I survived the entirety of the 2000s. I saw the dot-com crash, I saw the 2008 crash, and I'm still interested in getting to know the stock market and studying it. But I know many of my friends that went through that same experience just have no interest in the stock market, because the only thing they know is the stock market crashes on occasion. So it's just so interesting to me how the firsthand experiences that we have can so shape how we view the asset class essentially for the rest of our life.
Yeah, and that's something that I think is really important, and that we try to, I think a lot of people, yourself included, tried to impress upon retail over the last 2 years, which was, this isn't the regularity, proceed with caution, make sure that you're properly hedged, right, and have an understanding that this isn't going to go on forever, and now we're here. I think it's probably best that this happens sooner or later, that stuff is coming back down, because if it was just kind of up and down and treacherous for a while, I think that could become pretty exhausting. And a lot of long-term investors that I know are just happy that, hey, let's just reset, come back to, not necessarily, underneath, those March 2020 levels, but come back to whatever it is, June 2020, when we had just pulled it back out. That's kind of where stuff has come back to, and proceed from there, right, with a bit of a reset mindset.
Oh yeah, for sure. I mean, some stocks have taken a complete round trip to where they were essentially 2 years ago. I think that PayPal, for example, just got whacked really hard, and that's essentially trading at the same price it was in like May of 2020 or something along those lines. So there's a great company that has benefited hugely from COVID, is investing in crypto, really forward thinking in a lot of ways, and that has done a very high quality business that's been on a round trip to nowhere. So that's a hard thing to stomach. It also makes me, if you I know that everyone here follows Kathy Wood, or is at least familiar with her, with what's happening with ARK and everything like that. And I almost feel like the people that bought ARK, or that bought into the mindset of growth stocks, I don't know if they fully understood the ride that they were signing themselves up for. And for the record, I really like Kathy Wood. I really like her approach to investing. I think that she looks for companies that are on the verge of crossing the chasm, that are on the right side of the S curve. She makes bold bets on them, and she plans to hold them for long periods of time. That's a strategy that I very much endorse. And the unfortunate thing about that strategy, it was like a lot of our portfolios rewarded hugely in 2020, which brought in a flood of new capital, and that strategy has been hugely underperforming essentially over the last year. And there are people lashing out on her, and I saw Jim Cramer was like, bashing her on Mad Money, and it's like, well, that's her style. Her style is to look for dynamic, high growth companies that are on the S curve. And if you're going to invest like that, you're chasing after great long term returns, and you just have to know going into it, it's going to be an ugly, ugly ride sometimes.
Yeah, absolutely. And it's incredible, how these people are put under the spotlight, and they always seem to be making the right decision for a while, the wrong decision. But just like anybody else, right, dealing with the information that we have.
Well, think about this for a second. Can you imagine? Can you imagine the emotions that she must be going through over the last 2 years? And can you imagine how hard it is to manage somebody else's money? I mean, just think about that for a second. Think about all the pain that we've gone through on a personal basis by buying a stock and then having it go down. And my whole portfolio is down significantly from the high. Like, dealing with that on the inside when it's just you, and I'm not going to get fired. I'm not going to fire myself, right? That's one thing. Managing somebody else's money and having that person pissed off at you, even though you believe in the long-term viability of the strategy, that just sounds unbelievably challenging. And I do think that's one of the reasons that retail investors like us have an edge over Wall Street, is that we don't have to worry about career risk. We don't have to worry about making decisions that please other people. We don't have to worry about window dressing our portfolios to make it seem like we're doing right. We don't have to worry about assets leaving us to go look for the next hot fund. That is such an underappreciated advantage that retail investors have.
Absolutely. I got some pretty interesting questions that came in from the audience I'd love to ask. Wanted to start out with this one, which shout out to, let's see who put this in. And again, anybody that has a question, these are pinned up top. So this is from Degenerate Socialite.
Great name.
Yeah. They asked, was the meme stock movement good or bad for the market?
I don't know. That's a really hard question. If you're into meme stocks, and the idea is buy this meme stock, talk it up on any discussion board, and have that thing go through the roof. Obviously, that's a lot closer to gambling than it is to investing. I can tell you that the meme stock craze has been phenomenal for the likes of GameStop in a very real way, provided that company with a soaring share price that it could use to shore up its balance sheet and work on its business. So from that perspective, it's been a huge boon to the companies that have seen their share prices skyrocket. And on the other hand, it is also a way of people kind of banding together and voting to say, voting against people, the hedge funds and mutual funds that have huge amounts of capital and also try to manipulate the market. I've personally held many stocks that I'm a big believer in, and then I see some hedge fund, some fund take a huge short position in that company, and then go on a site or go on CNBC and then write a scathing article about that company and uncovering all kinds of ugly things and saying this company is going down, and invariably that same stock goes down 10%, 20%, and that person that did that, pockets a little gain at the expense of all the other shareholders that were selling. So it's very much akin to like that, but in the opposite direction. And instead of it being one person that benefits, it's many people that benefit. So I'm of two minds of it. I mean, if anything else, it's a fascinating story to watch.
Love it. Yep. I think it's something which still needs time to play out. I think it's still the relatively early days. I think we are going to see more volatility in this market, a boom back upwards. In several different areas. I'm sure there'll be more meme stocks, more short squeezes, things along those lines to entertain, and we'll see where retail rolls with them.
Sure.
Okay. Before we roll into this next question, we've been running for almost an hour here. If anybody hasn't already checked out, what Brian's doing on his timeline, I recommend clicking in, throwing him the follow. A lot of really good content. Always, see a lot of people around Twitter highlighting it, as well as the book. And then if you're liking spaces, I'm doing 20 spaces this week. I will be covering every major topic, including stocks, finance, crypto, options, NFTs, whatever you are interested in investing. I will try to have a space for you featuring experts, and then my co-hosts are great follows as well. So let's go to the next
You're a
question.
machine, man. 20. Wow.
Yeah, 20 spaces a week now, running about 30 to 40 hours, and it's a lifestyle.
Crazy.
Yeah, I actually was really, right after we met at FinTwit conference, that I really was like, this is just going to be my life now.
Okay.
And just like dove in, and just, now it's like, I don't spend less than 10 hours a day on Twitter, for better or worse. So
Love it,
we'll
man.
see where it goes. Brian, how much time a day would you say you spend on Twitter?
So it depends on the day, right? Some days 20 minutes, some days an hour and a half. It totally depends on what's happening that day. But Twitter, I view almost like crypto. Like when I first got onto Twitter, I was like, this thing is a god awful platform, and I'm just going to throw links on there to articles that I'm writing. But it was really in the last 2.5 years that I was like, wait a second, this platform is actually amazing for connecting with other people and learning if you use it the right way. So I freaking love Twitter.
Are you going to be at the next FinTwit conference?
That is still up in the air. We will see about that. There's a couple of conferences I'm trying to attend this year. So that's more of a discussion with the wife than anything else.
Okay, very fair. Well, listen, it's in Vegas, so
yeah, I know.
Bring the fam.
Yes.
Okay. Another question, more general. What's the best piece of advice you can give someone who's just starting their journey towards financial freedom?
If you're just starting out now, and you're interested in the stock market, the same advice I get to everybody: always start. The first step to investing is educate yourself. Study, like learn. Ask yourself: do you enjoy this thing? Is this just a flash in the pan side hobby, or are you actually interested in learning about it? It's perfectly okay if it's just a temporary interest, and if it coaxes you to invest in index funds, dollar cost average, and you never think about it again. Great, you'll be in fantastic financial shape for the rest of your life. But if you're interested in this kind of stuff, and if you're curious about what happens with companies, why do their stocks move in certain ways, start by educating yourself. It's never been easier to do so. There are so many wonderful podcasts that are out there. There are so many wonderful people to follow on Twitter. There are lots of great YouTube channels. There are lots of great books that are out there for learning about it. Even some of the older classic books, like One Up on Wall Street, The Motley Fool Investment Guide, The Warren Buffett Way, the Warren Buffett and the Interpretation of Financial Statements, books like that. The principles that are in there still hold up today. Some of the individual lessons of the time are a bit outdated, and some of the business models are a bit outdated. However, always start by educating yourself. Oh,
Definitely.
and then beyond that, nothing makes you learn faster than having skin in the game. Nothing. Nothing will make you learn how to invest faster than actually putting a few $100s into a company and then watching what happens next. It's one thing to be able to say you can mentally withstand volatility and you can take it when a stock goes down and going up, and saying I'm open to that. It's an entirely different experience when you actually have money on the line. So education and a little bit of skin in the game will go a long way to turbocharging your knowledge.
Yeah, absolutely. I say the same thing to people, regardless of the asset class that I'm talking about, even with crypto and other areas. I tell people, like, you're just not going to care if you don't own any.
Yeah.
And what I really compare it to is college, right? Why do people go and take specific classes that are outside their major? I think a lot of people, like myself, I wanted to learn how to code Python. And I went online and I bought a course and I did it for a day or two and I just stopped. I was like, there is nothing pushing me to do this. There's no reason. So I had to put myself into a college course where when I was in college at the time, and I signed up for a coding class. I was like, good. Now I have a teacher. I have grades. I have a reason and skin to do well. And I went ahead and learned it. I see it the same way with the stock market, with crypto and all these things, where if you don't have that money in, there's no repercussion. There's no drive, and we're pretty fickle human beings, most of us. So when we don't have it, we tend to lean towards the areas where that we do have skin in the game, and right. And so and those can be all different areas of life. It doesn't have to be investing. So I find to pull ourselves in, I completely agree with you about needing to put that actual capital to work.
Yeah, I love that. And another analogy that I always tell people is it's like how much do you care about a U9 little league game in your town? The answer is zero. You have zero care about the kids playing, about the score, or anything like that. But if your kid is in that game, how much do you care? All of a sudden, you care a lot. Well, how do you do the same thing in the stock market? You put a little bit of money, you put your skin in the game, you're suddenly going to pay attention.
Yeah, it's kind of like sports betting. Have you ever sports bet?
I have not. I guess just like on the Super Bowl, that kind of thing. But I haven't done any of the FanDuel or anything like
All
that,
right,
because
so
that's what you're referring to.
the Super Bowl is a big game. I'm talking middle of January. Knicks, Pistons are playing. You don't know any of the freaking players on the floor besides like Julius Randle and Jeremy Grant, and you don't care. And then your friend goes, "Hey, you want to put $5 on the over?" And the next thing you know, you're sitting there screaming at the guy to make those goddamn free throws,
Yep.
and he better, or you're going to throw something. And it's the
Yeah.
same exact way.
It's why fantasy football is so good for the NFL, right? What I care about a wide receiver on San Francisco does. Well, you have him on your fantasy football team, suddenly you care.
Exactly. Okay. So just one or two more questions, and then we'll wrap up. I know that we put it at an hour. I just had one or two more things I really wanted to hit on. The first one here was, especially nowadays. So one of the topics basically that you had kind of provided was why share price can be so misleading. Do you think that still is in effect now with fractional shares?
The dollar price of one share, you mean?
Yes.
Oh yeah. So the human psychology is still there, right? So when I first started investing, the only thing that I knew was the price of the stock. End. Like, that's it. The company name, the ticker, the price of the stock. That was the extent of my knowledge. That's still very much the case today. In fact, if you pull up the stocks app on an iPhone, what's the thing you see? You see company name, ticker, price. That's it. And because of that, a whole bunch of people naturally focus on the stock price, and they say, Amazon, $3,000 a share, forget it. Sirius XM, $5 per share. Now we're talking, right? So that is still very much a natural focus that a lot of people go to. To your point, though, one of the gifts that investors have been given is the ability to buy and sell in tiny, tiny fractions of a share. So if you want to invest $50 into Amazon, you now can. You want to invest $10 in Google stock, you now can. So I still think the psychology is there because people overly focus on price, and it's natural too. But to your point, the fractionalization of shares has been such a gift.
Yeah, it absolutely has, and it's kind of getting taken to the next level in some other areas. That idea of odd lots and fractional shares. So I'm pretty excited to see the future of that. I think there's a lot that can be created within it. Okay, I have one last question, but before I do ask it, Evan, Stock Market News, do you have anything you want to put out there?
I will not come in and steal your last question. I will add on top of this, the psychology of sports betting is the exact same thing. We're talking about this here. Caesars, I'm in New York. They had a promo where they gave you free $300. It wasn't my money. I did not care. We didn't get into that thing. But the second I started to bet that $10, that $5 of mine, I cared. And I was all in on it. And I actually was looking up the research, doing whatever research I guess you can for sports betting. It's not something I recommend. But yeah, just wanted to hop in on that. Big shout out to Brian and Wolf. This was an awesome space to listen into. If you're in the crowd and you're from one or the other, make sure you're checking out both of them. Give both of them a follow, and check out Brian's book in his description. But yeah, I won't steal your last question. Maybe we got to get another one and we can do this together. But yeah, all back to you.
Perfect. Appreciate it. Yeah, Stock Market News is a great follow during earnings season. He's basically the first one breaking all the information. So if you're the type of person who is busy and doesn't want to go listen to every earnings call, I recommend checking out his account. Okay, Brian, my last question here is, if you're comfortable sharing, what are currently your top 3 holdings and why?
So I don't check my portfolio every day, but I'm pretty sure I can give you my top 3 holdings. The why is the easy part. I bought them and didn't sell them. That's it. I have my broad strategy is to buy great companies and hold great companies. And my biggest holdings are my biggest winners. The stocks that go up the most naturally occupy bigger spots of my portfolio. The stocks that occupy smaller and smaller and smaller parts of my portfolio and eventually become irrelevant tax loss lessons in how not to invest. But last I checked, top 3 holdings were number 1 was Tesla, number 2 was Mercado Libre, and number 3 was Google. Yeah, roughly those 3. And again, the reason that there are 1, 2, and 3, I would never have guessed 10 years ago that I'd be where I am today saying, yep, Tesla's my number 1 holding. But it is. And that's because it's up umpteen 1,000% since I started buying it in 2011. That's it. Same thing with Mercado Libre, and same thing with Google. Google is actually the stock that I've held the longest. I made my first purchase of Google in 2009, and I just haven't sold it. So great example of find great company, buy great company, do nothing.
And have you been dollar cost averaging into them over time?
A little bit. I do what's called I try and buy at better and better value points over time. So to briefly explain what that means, you whenever you make a purchase, you write down what the price to sales ratio is, what the price to cash flow ratio is, price to earnings ratio, etc. A couple of simple metrics. And I try and be very price insensitive or valuation insensitive with my first purchase. So let's say I bought Google at 15 times sales with my first purchase. What I'm trying to do with future purchases is get a lower price to sales ratio than the 15 that I initially paid at. So there's two ways that can happen. First is the stock price goes down. So then I'm getting at a lower evaluation. The second way is the stock price can stay flat or go up, but revenue goes up faster than the stock price did. So I don't try and time the price in any way. I try and more focus on the valuation and continually buy at better and better valuations over time. That's my broad strategy. But with those three companies, I think I last added to Tesla in 2019, last added to Mercado Libre in 2014, last added to Google in like 2012 would be my guesses there.
Wow. Yeah. Love it. Definitely trying to get into a mindset like that. Much newer to investing than you are. Excited to have this long timeline. I know a lot of my audience has a pretty wide range and spread, but regardless of where you're at, it's not too late to find great companies and hold them for decades, unless you don't have that time. But I think most of my audience does. Most people on Twitter probably do, especially if they're spending hours and hours of their time here each day. It was really an honor having you on, Brian. Very excited to do this. And your big thing that you asked me about actually when we were at the conference, will we be able to record? They actually ended up building in to Twitter.
Look at that.
Yeah. So I also did ask one of the guys who helps me out to actually come in and screen record this. So hopefully we should be able to get this onto YouTube and Spotify by tomorrow, as well as all other major audio platforms. We'll obviously share this link out on Twitter immediately following this. Just incredible having you on, and looking forward to the next one, especially now that you're doing more spaces, and maybe we'll dive into a more specific topic for the next one, or some analysis of top companies. I know you're doing some research and write-ups, and would love to just give you the floor for anything else that you would like to share.
Sure, that'd be awesome. Thanks so much for having me, and thanks for listening to me ramble, everybody. It means a lot.
Always a pleasure. And I did actually track analytics for this space. We did get about 2,000 people came through here in 1 hour, so that was awesome to see. We held about 500 people the whole time. Really, appreciative to our audience for tuning in. If you are interested in Twitter Spaces, last thing I will say, and then we'll end this in 1 hour, less than an hour, 53 minutes. And Brian, you actually mentioned Bitcoin, so maybe you'll be interested in this. For anyone who's familiar with Bitcoin, you probably have heard of the Bitcoin Magazine. It is a verified page on Twitter with 2 million followers. I will be doing a space with them in 53 minutes at 7 p.m. The managing director of the Bitcoin Magazine, who also runs the Bitcoin conference in Miami, will be coming on the space for a 30-minute interview with myself, Stock Market News, and Asset Dash, an up-and-coming startup in the finance space. So looking forward to that, everybody. I'm going to put out a reminder tweet for it right after we close this out, and I'll see you all there. Make sure that you're checking out Brian's book and everything we did here. And take care. That's all I got. Take care, Brian.
Thanks so much, everyone. Have a good night.